this week's market update. Brexit vote leaves investors on tenterhooks, US earnings season kicks off, and China trade rattles markets. There are big market stories all around the world this week, with politics, corporate news and global trade all in the spotlight. Here, Brexit is the main focus, with this evening's delayed vote on Theresa May's withdrawal agreement heading towards likely defeat in the House of Commons. That will surprise no one, as the deal is disliked on all sides. What follows does, however, have the potential to unsettle both the political landscape and financial markets. So, what are the various options? Well, the first is that, against the odds, the deal is actually voted through by MPs. If this happens, the government introduces legislation and, assuming that's passed, Brexit comes into force on the 29th of March. That's when the real work of negotiating our future trading relationship with Europe would begin. This outcome, however, is unlikely. Much more likely is that MPs vote the deal down, perhaps by a humiliating margin of 200 or more votes. If this is what happens, there are 5 possible further options. If nothing happens before the 29th of March, the default position is that we leave the EU without a deal and continue to trade with Europe on so-called World Trade Organization terms. That means a set rate card of tariffs is applied and other rules must be adhered to. The second option is that the government comes back within 3 days and proposes the negotiation of a new Brexit deal, which might look more like Norway's relationship with the EU, political distance but access to the single market. In Britain's case, it would probably also involve membership of a customs union. This would obviously start another lengthy process, would involve a U-turn by the government, and would involve a request to extend the Article 50 timeline beyond the 29th of March. So it would not be simple. The EU would have to approve the request unanimously, and MPs at home would also have to vote on it. Option 3 is a general election called by the Prime Minister. Again, not a simple process, thanks to the Fixed Term Parliament Act, which means that 2/3 of MPs have to support a move to go to the country before 2022. And yet again, this would involve an extension to the Brexit timetable unless the election were called very quickly. The earliest it could be is 25 days after it is announced. Another way we could end up at a general election is if Labour were to call a vote of no confidence and win it within 14 days. Again, quite a tall order. And if it were to happen, it would probably require an extension of the timetable. Option number 5 is to call another referendum, accepting that Parliament and the government can't sort this out, so the people will have to decide. This is not a great option because of the potential for social division. If Remainers narrowly reverse the vote, many Leavers will be extremely unhappy that their democratic call for change has effectively been ignored. If Leave narrowly win, we're back where we are today, and the deadline will have long gone. That's because staging referenda is tricky and is expected to take up to about 22 weeks to do properly. One further possibility is that Theresa May could decide she's had enough and resign. That would trigger a leadership contest and someone else could pick up the poison chalice. So, in summary, it's still very messy. What might the market reaction be this week? Well, the UK stock market, in line with others around the world, has had a good start to the year, bouncing back to a limited degree from the weakness in the fourth quarter last year. Now, that may be at risk in a number of these possible scenarios, particularly any which make a Labour government look more likely. And that's because Labour has already been clear that it's contemplating a number of market unfriendly measures, such as widespread nationalisation and higher taxes. The immediate impact of further political turmoil would also be felt in the currency and fixed income markets. We're already seeing evidence that investors are bracing themselves for weakness in sterling because so-called break-even inflation rates, that's the difference between the yield on nominal bonds and those on index-linked bonds, have risen sharply in the past week. And that's because a fall in the value of the pound would be likely to stoke a rise in inflation. Looking 5 years out, the markets are now assuming an inflation rate of 3.2%, and that's well ahead of the Bank of England's 2% target. Lifting our gaze from Brexit, if we can, the rest of the world is rather more concerned about the other 2 big market movers this week, corporate earnings and the trade situation. After last year's tax cut-fueled surge in US corporate profits, this year is bound to see a slowdown in earnings growth. Just how significant that is will start to come into focus in the weeks ahead as fourth quarter profits are unveiled by America's biggest companies. Overall, earnings are forecast to rise 15% year on year, much slower than the previous quarter, but still a healthy rate of growth, and the fifth consecutive period of double-digit gains. Unfortunately, investors are already looking forward to results in 3 months' time, when growth is expected to have slowed even further to about 4% year on year. Chinese growth is slowing, and signs are that Europe is following it down too. Even in the US, recent weakness in manufacturing data is beginning to feed through into confidence and hiring intentions. Yesterday, we saw the start of earnings season with a downbeat announcement from Citigroup, which had already warned that the final 3 months of 2018 would be hit by a sharp drop in fixed income and trading. Despite the fall in revenues, down 16% year on year, including a 21% fall in fixed income revenues, earnings emerged slightly better than forecast and well ahead of a year earlier, thanks to falling expenses and a lower tax rate. Now, the final big market mover is likely to continue to be progress, or the lack of it, on trade talks between the US and China. The stakes are high as this week's export data in China confirmed. The world's second largest economy announced a sharp drop in exports in December, sending Asian markets lower as a global slowdown and the unresolved trade spat with America start to take their toll. A 4.4% fall in exports came despite a rush by exporters to ship orders ahead of a threat of rising tariffs. Moreover, a 7.6% fall in imports in December showed the extent of China's growth slowdown as investment slows and consumption weakens. Car sales in China, the world's biggest market, declined in 2018 for the first time since 1990. Meanwhile, foreign investment into China barely grew at all last year. That was down from an 8% rate of growth in 2017, and despite Beijing's efforts to loosen restrictions on overseas investors. And finally, back at home, 2 weeks into 2019, we're starting to get a clearer picture of how Christmas and New Year trading was for Britain's beleaguered retailers. Actually, things have turned out a little better than feared by investors in the run-up to the holidays. All the food retailers except Asda have now issued trading statements, and more than a few of the general retailers too. The picture is mixed but not disastrous, and that has been reflected in some pretty sizable recoveries in share prices so far this year. In general, those retailers who were doing badly last year have continued to do so, but there have been as many like-for-like sales improvements as worsening situations. The move online has clearly continued, so those companies well positioned in that space have benefited. The major question, however, is the extent to which sales have been bought at the expense of profits. For that information, we'll have to wait for results announcements. The sector is not out of the woods just yet.